Well, hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics. And today we're going to go into some long history of mining stocks versus the stock market to see what happened during major financial crises when miners finally bottomed, how they did it. And we're going to go through some freaky, repetitive chart patterns and why silver is on a major fault line that if it succeeds in testing it, we should be off to $30 very soon. I want to start out talking about Silver Squeeze 3 and timing. You see, Silver Squeeze 1 was a big success, but the timing was a little bit off, and I'll show you exactly why. First, this video is sponsored by Fortuna Silver Mines. This is their breakdown of production. They've got 22% silver in revenue, 69% gold. And yeah, it makes them look like a gold miner. They were a primary silver miner until last year when they acquired Rox Gold. And that has confused a lot of investors because their name is Fortuna Silver Mines. So there was a big sell-off when they pretty much changed their identity slightly. But if we take into account the gold to silver ratio, which right now is around 80, when it does fall to around 15 to 1, and it will, how long it will stay there depends on how long a monetary crisis will persist. But once it does go there, and hopefully it will stay there if we remain on a silver standard after this end game runs its course, which would be the healthiest thing for the monetary system, of course, then the gold to silver ratio here in terms of revenues will more than balance out. And at a 15 to 1 ratio, that would increase silver's value relative to gold by about 4 times, which would make Fortuna Silver a primary silver mine once again. This chart is of transparent gold holdings, meaning all gold that is held in transparent funds like ETFs and other unallocated and allocated funds. Say what you want about them, but this is the entire record. Now, the point of this chart is to show you the box that I put in the middle, the black rectangle, is around when Silver Squeeze happened. You can see here, here's 2021, January, February, so it was around this line over here that my arrow is moving up, right around here. And what was happening around here is that the total transparent gold holdings in these funds was on its way down, meaning interest in precious metals generally was on the wane. So while we did have the silver bugs and the silverbacks with us, and that's why Silver Squeeze 1 was a big success for its time, it was timed at a moment when precious metals investors' interest was waning. It bottomed here at around May 2021, bottomed around here again, October 2021, and now it is on the way up again. And this is the same with silver holdings. But the investing public, who, while they don't really want physical silver, they do want exposure to the price, and that, even though it is not what we advocate, it is something. Next thing I want to go into is physical silver premiums. The price might not be moving that much on the COMEX, and we'll get into that in a second, but premiums they're on the rise again. They have almost hit 18%. This is back here, Silver Squeeze 1, right here, and this surge, and it has not backed off since. Once we pass 18%, we could get the public's interest back into physical silver. We'll see what happens in the months and weeks ahead. As for the technical position where we are now, this is a daily chart. It is quite obvious that we are on a fault line in the daily charts. This has been a pivotal resistance support line since back in October. Here we hit it once, here we hit it again, here we hit it a third time, and now we're coming back and retesting it, sandwiched between the 50-day moving average and that line. And that wouldn't be so significant in its own right if not for the weekly charts, which show that we are just on top, touching exactly the 50-week moving average, which happens to be on the same line. And if this is a successful test, we should remain above the 50-week moving average. If we break it, it should be brief, and it would be a buying opportunity. But this is showing you that the 50-week moving average is being heavily watched by technicians. And once they get on board, we could see a surge to 30, and that's why I say it could be soon. I wanted to check in At the world's sickest bank, which has been making big moves lately, huge moves since, let's say, around March 2022, last month, when Societe Generale, which is a great name for a sick bank, General Society, which is also pretty sick right now, I think we can all agree on that, has collapsed from a high around 8.5 to a low just around 4. This is the most leveraged bank in the world. When it falls, all banks will fall. I have a feeling this will be the first one. It is even sicker than Deutsche Bank by its numbers. This is what happened to it during the March 2020 lockdowns, and it made a low around May 2020. And once it passes that low, I believe that the financial system could implode with this General Society bomb. I want to show you some freaky charts here. This is a weekly chart of gold going back to 2020. Obviously, we all remember this when silver hit around 1050 and gold collapsed to around 1450, and then a move back up here to the all-time highs, and then a cup with a bottom around here in March 2021, then a surge up here to around June 2021, and finally, we reach those old highs again, and we are back in a triangle. Now watch this. Recognize that chart? Let's go back again. Right? It's the same chart. It's the same pattern, except this one is gold going back to 2007. Here we have the 2008 financial crisis, the equivalent of the March 2020 collapse. Here, a move to all-time highs, which is the equivalent of August 2020, both for gold and silver. And we have a return to new highs here, and then another bull. Really, this chart over here, going back to 2020, is really this section over here, this bull. This is a pattern that keeps repeating. There's something else going on in the technicals in miners, gold and silver miners. We are on a major historic fault line here, going back all the way to 2008. This is gold miners priced in gold. The higher, the more bullish, the more valuable the miners are relative to gold and silver. Here is the 2008 financial collapse, which really kicked miners in the teeth, and we held here at about 0.086. And 2013 was the gold and silver bear market, really intensifying itself, and this was the final test pivot point when we hit into a major bear market, and we finally bottomed right at the beginning of 2016. We went straight up, right back to this support zone. And we almost broke it over here in 2021 when silver hit its high, and now we were testing it again. This is a very long-term chart. Once we break this line at around 0.086, and we're on it basically now, once we push through it and we've successfully test that line, I think we're going much higher in gold mining stocks and silver mining stocks especially. And now I want to bring your attention to some history going back to the Great Depression. You'll see here the Dow Jones Industrial. This is the 1929 crash right here, and proceeding down into a bear market low 1932. This is the 90% in stock prices lost during the Great Depression. When did gold and silver start to really take off? When did gold and silver stocks really start to take off? It was at the bear market bottom. You see here, they never participated in the bubble, just like they are not now. So it is not unusual for silver mining stocks to not participate in a stock bubble. That is exactly what is supposed to happen. But once the market bottoms and the Fed starts printing again, which is what they did here through revaluing gold from 21 to 35, you see here that vertical line, that is the revaluation of gold from $21 to $35, which is what allowed them to print more money. That is when home stake mining really started to skyrocket, and the Dow Jones didn't really go anywhere for another 10 years. Can we expect something similar today? Absolutely. But this time it's going to be hyperinflationary because, of course, there is no monetary standard. And so we are on a technical fault line here, just waiting and watching.